Now's the time to buy a house, and I'm going to give you 3 reasons why, if you're waiting for either home prices or interest rates to come down, you're going to be sorry. And it's demand, inventory, and concessions. If you've been watching the news at all, you've likely seen a lot of headlines like these suggesting that the market is anticipating the Federal Reserve will cut rates in 2024. Now, the federal funds rate is at 5.25 to 5.5%, and the expectation is that they will cut anywhere from 0.5% all the way up to a more optimistic prediction of up to 2.75% in 2024. And with this expectation in place, the market tends to get ahead of it. And we've seen that with the 10-year Treasury yield dropping from over 5% in October to now we're down at about 4.12, 4.13%. And thus, 30-year fixed rate mortgages, as we know, follow 10-year Treasury yields, and they have as well come down. And we've seen the mortgage rates drop from over 8%. Now we're sitting at around 7%. And the expectation is they're going to go lower. So if that's the expectation, why wouldn't you just sit back and wait for rates to go lower before you buy? The first reason, as I discussed, is demand. It might seem funny that I'm talking demand when we're sitting here with existing home sales at lows not seen since 2010. But the reason we're talking about demand here is we've seen, and we saw it at the beginning of this year, that every time we see a drop in mortgage rates, we do see an uptick in purchase applications. And if you take a look here at the graph, you'll notice that in early 2023, we saw the 30-year fixed rate mortgage drop from 7% down to 6%. And we did see an uptick in mortgage applications for a couple months. Then with the rates going higher, we saw that demand start to slump off and obviously continue as we saw rates spike all the way up to 8%. But we're already seeing a sign of applications starting to uptick here in the last couple weeks as we've seen rates drop from 8% down to 7%. And if the expectations of rates continuing lower and getting back to the low sixes, there is a lot of pent-up demand out there. And there's a lot of people sitting on the sidelines, and all of a sudden, getting back to a 6% looks very attractive when we're coming from an 8% level. Next up is inventory. I've been pounding the table on inventory, or lack thereof, for a number of months now. And as you can see here from the chart, you'll notice that it's in a constant decline. We do have some seasonality in there, but overall it's been declining. And we're now sitting at about 1.15 million units. As you can see, back in 2008, this is for all the home crash people out there saying that we're going to see price declines of 20% or more because we're in a situation like 2008, which we're not. You'll notice that we saw a continued rise of inventory until we got to the peak of over 4 million units. Second, if you look at this next chart here, you'll also notice another factor that comes into play, and another big difference between 2008 is the growth of the US population. Right now, we have 30 million more people in the US than we did in the crisis, and about 19 million more in the workforce. So the demographics have changed considerably in that time frame. And that also adds to the problem, because when we do see a pickup in demand, we have more people that are chasing, obviously, a lot fewer houses. And unfortunately, we're not going to see a dramatic increase in inventory. Yes, when we see rates come down, there is going to be an uptick in some sellers that are also waiting on the sidelines. But it's not going to be as drastic because most people are sitting on a mortgage of sub 4%, a lot of them at 3% or below. And if they don't need to, are likely not going to move up because the rate is now 6%. Now, there are obviously life issues that happen and maybe a new family member, things like that. So there's always going to be movement. There's always going to be home sales. But as we mentioned, existing home sales were at lows not seen since 2010. And just to get back to averages, we've got add about 1 million existing home sales. Now, new home sales have bridged a little bit of the gap, but keep in mind, new home sales are only about 10% of the overall home sales. And this year, they're about 15%, and that's because there has been an uptick in new home sales, but also because of the big decline in existing home sales. But overall, new permits pulled are not tracking at a significant increase. Overall, they're fairly flat. And so we're not going to see any big uptick in inventory coming from that. So the real inventory is going to come from existing home sales. And unfortunately, that lock-in effect is going to stay. Another piece is everybody thought there was going to be a flood of homes from the gray tsunami. All of the baby boomers retiring were going to start selling their homes to downsize and everything else. And the reality is that most of the baby boomers own their homes free and clear or with a very small mortgage, and the majority of them have opted to age in place, much more than what was anticipated. So likely we're not going to see a huge inventory gain from that population anytime soon as well. Now, the last thing I want you to take from this is seller concessions. I want to show you a cost of waiting type analysis, but the reality is right now, we're in a time frame where seller concessions are on the table. Some of the headlines have said that more and more houses are dropping prices. A lot of you have probably heard of getting concessions for rate buy downs. The other form of concessions is for paying for closing costs. Currently, we're not at any higher amount of seller concessions than historically. Historically, about 30% of all homes sold have some form of price cuts. And I put seller concessions in price cuts because that's another way to take a price cut. And in most cases, I believe it's a better way than taking a price cut. And I'll show you the math here right now. So let's say that you're looking at a home with a purchase price of $500,000 and you're going to put 20% down, so you've got a loan amount of $400,000. Let's say current rates are at 7%, and therefore you're looking at a principal and interest payment of $2,661. Now, if you wanted to wait, let's say a year for rates to come down for, let's say, a 6% target, then you're looking at a payment of $2,398. And so the difference on the principal and interest payment is $263. Now, let's say currently on that $500,000, you could negotiate $10,000 in seller credit. So either they'd lower the house payment or they would give you a seller credit. You decide to look at the seller credit to cover closing costs. And therefore, you take that $10,000 that you would save, that would be an out-of-pocket cost, and instead divide that with the $263 a month, which is the higher payment, and it's a 38-month payback period. So that's kind of your break-even point is what you're looking at here. And then let's look at that versus where you decide to go ahead and wait the year. And in that time frame that you waited a year, the price is appreciated by 4%. And keep in mind, that's kind of the standard appreciation. And if rates go down, the likelihood of that appreciation, even with the high prices, is still very probable. Right now, we've seen an appreciation of 6% with these abnormally high rates. So all of a sudden, that same $500,000 house you're looking at is $520,000. The loan amount is then $416,000 with the same 20% down. In 1 year, you're looking at that 6% rate that you're waiting for, and you've got a payment of $2,494. Now, of course, that payment is a little higher because you've got a higher loan amount of $416 versus $400,000 with the same 20% down. Also, you paid an additional $4,000 on the down payment because of the higher priced house to get to that 20% down. Now, the difference in payment now is $167 versus if you had done it at the higher rate of 7 initially. And you've also lost $20,000 in appreciation, as you can see. And that likelihood of getting the $10,000 in seller credit is also diminished because in a market with lower rates, there's going to be more competition, like we mentioned before. And therefore, being able to negotiate that seller concession is going to be much less likely. As a matter of fact, I'm more concerned that we're going to get into a point where we're going to have a condition not as crazy as 2021, but more like 2021, where you're going to have multiple bids on a lot of these properties, especially at, a $500,000 property. So this is the third reason. Right now, there is a good chance to get seller concessions. Now, again, maybe it's only 30% of the property, so maybe you're going to have to shop around until you can get that, but there is more of a likelihood to get that. So think about, yes, you're going to have a higher principal and interest payment, but you're also saving $10,000 potentially in out-of-pocket costs. And what's more important to you right now? Also keep in mind, all of this is speculation on what rates are going to do, right? I mean, we anticipate from what's happened historically and what's happening with markets and the fluctuations and so forth, not to mention throwing in a election year, that rates will continue to drop. So the likelihood, I mean, we don't know. I mean, if we had a crystal ball, we wouldn't be here. But the likelihood is pretty good that rates will come down. And if so, the likelihood of demand increasing and surpassing any increase in inventory is definitely a likelihood. But what I'm getting at is you still have to be comfortable with the payment now. If you do decide to buy now, you can't buy now wholly thinking that you're buying just because you're going to refinance in a year, because you never know what's going to happen. So you do have to be comfortable with the payment now. But assuming you are, this is the reason why I think it is the best idea to buy now rather than waiting. Tell me your thoughts. I'd love to hear them.